February 6, 2024. Hope everybody's having a fantastical day out there. It's a pretty nice day here in Colorado. Not too hot, not too cold. Still tons of snow in my yard, but that's not going anywhere for a while because unfortunately my front faces north. So all this out here never gets any sun in the wintertime. So sometimes there's snow in my front yard till like May. I mean, it's actually snowed here in June. What year is that? 2020. I think we had 10 months where we had snow in it. The only two we didn't were July and August because we had snow in June. I mean, snow in May is fairly common, but we had snow in June and then we had snow in September, which is a little odd. So anyways, you didn't come here to hear about my snow forecast or anything like that. You came here to hear about what happened in the markets today. Seemed like things were in a slightly better mood. I mean, markets appear pretty flat today, but we'll get into that and some stories about what's happening behind the scenes. And that'll be it. Sound good, everybody? I think so. All right. Well, if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press that notification bell. I apologize. I am a few minutes later than I normally. I try to usually get started right after the market closes, but I've been doing some maintenance here around the house. Got to remove this amazing piece of technology that's in the hallway out, or was in the hallway here on the downstairs. See, if you have a house from the 70s, you get this fancy technology. They had like a speaker system and all sorts of cool stuff. Unfortunately, the other part of it, you know, what would normally be upstairs, and I imagine there was probably one in the master bedroom, and then there's a speaker outside at the front door. The rest of the components are gone. So this was the last piece. So I'm not sure. Maybe I'll hold on to it and you know, frame it or something. Anyways, all right. Well, let's go ahead and get into the news and see how the markets did today. All right. Dow Jones was up 0.37%, 141 points, closed at 38,521. The S&P 500 was up 0.23%, closed at 49.54. NASDAQ up 0.07, closed at 15,609. The VIX fell 4.46% today. It's down to 1306 again. Canada was up 0.41, Brazil was up 2.18%, and Mexico up 0.79. Over in Western Europe, Germany was up 0.76, the UK was up 0.9, France was up 0.65, the Netherlands up 0.82, Spain up 0.62, Italy up 0.53, Switzerland down 0.26, and Portugal up 0.21. Russian exchanges were mixed today. The MOEX up third, RTSI down 0.48%. And the Asian markets, the Nikkei was down 0.56%. Australia was down 0.58%. New Zealand down 0.39%. In China, the Shanghai was up 3.23%. The Shenzhen Component up 6.22%. Boy, it looks like these markets are really jumping after the last week where I think it was due to the Evergrande, I think, if memory serves. I saw some articles about it. The China A50 is up 2.89%, DJ Shanghai up 3.87%, Hang Seng up 4.04%, and the Taiwan weighted appears to have been closed. All right, so those are our markets for today. Like I said here, domestically, things were pretty much holding the flat line all day, and actually we can go to the daily chart and take a look at it. Here was the Dow Jones just kind of back and forth from a range of up about 0.46 to about 0.8. Same thing with the S&P 500, kind of back and forth along the midpoint or the starting where we started, where the open. Gosh, and then had a nice jump here at the last few minutes. Same thing with the Nasdaq, very similar chart, back and forth, and then finished off in the green. So. All right, so that's what's going on in the stock markets today. Let's get our news up here. Let's get to the market recap for today. U.S. stocks struggle for direction as tech takes a breather. All right, on Tuesday, U.S. stocks struggled to find direction with tech weakness, particularly in chip stocks like AMD, weighing on the market. Despite this, positive corporate earnings reports helped mitigate losses. Eli Lilly slipped 1% despite beating fourth quarter estimates, driven by strong demand for its new obesity and diabetes drugs. Planeteer Technologies soared 30% after reporting Q4 beats on both top and bottom lines with increased commercial revenue. Wedbush raised its price target, citing Planeteer CEO Alice Karp's leadership in AI. Spotify Technology narrowed its losses in Q4, with revenue climbing 17% and surpassing Wall Street estimates, leading to a 4% rise in its shares. Tech stocks, however, faced downward pressure due to weaker semiconductor performance, with NVIDIA, AMD, and Rambus Inc. leading the declines. Doku, a company that has been in talks for potential acquisition, fell over 3% after announcing layoffs and signaling its intent to remain independent. Federal Reserve officials reiterated a cautious stance on rate cuts, emphasizing the need to address inflation. Minneapolis Fed President Neil Kashkari noted that recent inflation data showed progress towards the 2% target, but cautioned that more work is needed, meaning we got a ways to go before they're going to cut rates, or something bad's got to happen in the economy. It's one of the two. I mean, because they're just not going to cut rates willy-nilly. I just don't see that happening. Cleveland Fed President Loretta Meester suggested potential rate cuts later in the year if inflation continues to ease, but stressed there is no rush in making such decisions. And our last article, we'll talk a little more about that. Next up, some not so good news. New York Fed sees trouble in auto borrowing as overall debt level rises. And having been someone who spent the better part of a decade in the collections and recovery field, that aspect of business is still very near and dear to my heart. And, so when these things start to rise, that typically means not good news in the economy. All right. In the final quarter of 23, total household debt in the U.S. rose by $212 billion to reach $17.5 trillion, according to New York Federal Reserve's household debt and credit report. Despite this increase, overall delinquency rates remained below pre-pandemic levels, with 3.1% of outstanding debt in some form of delinquency, up slightly from the previous quarter, but lower than before COVID-19 struck. The report reflects credit conditions in an economy experiencing robust growth alongside high inflation and aggressive interest rate hikes by the Federal Reserve. Excuse me. Delinquency transition rates increased for all types of debt except student loans, with credit card and auto delinquencies rising to 8.5% and 7.7% respectively. However, the New York Fed notes that student loan payments faced a unique situation due to periods of forbearance and forgiveness. While delinquency rates have risen from historic lows, households entered the pandemic with strong balance sheets, bolstered by government assistance. Yeah, we know what that's done to us with all this inflation. Despite accelerated credit growth and increased debt servicing costs, the overall credit outlook remains steady, according to Gregory Dacko, chief economist at EY. Homeowners, especially those with low mortgage rates, have been less affected by the Fed's tightening cycle. Auto loan delinquencies are now above pre-pandemic levels, attributed to higher car prices and borrowing pressures. New mortgage borrowing rose by $112 billion to $12.25 trillion, and credit card balances increased by $50 billion to $1.13 trillion. Serious credit card delinquency surged across age groups, notably among younger borrowers. Mortgage loans transitioning into trouble remained low, while borrowing through home equity lines rose for the seventh consecutive quarter. Again, pay attention to delinquencies because they're kind of a good gauge of, where the economy's going, because as people start to feel the crunch, they get laid off, they don't have money to pay the bills, they start borrowing. Again, I was one of those guys calling and hunting down deadbeats. I know what it's like to have to track down people. I mean, it's got to be much easier today, because back in the 90s, we didn't have you had the internet, but you didn't have all these directories and systems to find people. There was no Facebook or any of that stuff. So tracking people down, used a lot of 411, and working for AT&T, we had the phone records, which was really, really nice. So anyway, again, pay attention to what's happening with delinquencies. If you see an article talking about it, typically that's a leading indicator, as opposed to, the jobs numbers, which those are lagging indicators. Again, you don't fire people until, times get bad. And, when businesses really just, can't hang on any longer, it's either shut the doors or fire some people, and, they'll fire people before they actually close the doors. So I wouldn't really pay attention too much to the employment numbers, because again, those are lagging. When those start to show a really bad trend, we're right in the middle of it at that point. So we'll be aware. All right. Last up is an article from Zero Hedge titled "The Fed Cannot Cut Rates as Fast as the Market Wants." And this was written by Daniel Lacal. Let's see what Mr. Lacal had to say. All right. Daniel Lacal's analysis highlights a significant shift in market expectations regarding rate cuts following recent economic data. Initially anticipating rapid and substantial rate reductions, investors have now recalibrated their forecast as the probability of a March rate cut plummeted from 80 to 19%. Federal Reserve Chairman Jerome Powell's remarks further underscored a more cautious approach to monetary policy adjustments. And I got spots on my glasses, probably from using the sander in the hallway before I painted, and I got little dust particles all over the place. So hang on a second so I can see. I mean, I can see perfectly fine. I just can't see the monitor. That's the downside of being farsighted. So, I mean, at least I don't have to wear glasses to drive or anything. All right, where were we? Policy adjustments. All right, while headline macroeconomic indicators paint a rosy picture of a robust economy, solid job creation, and low unemployment, Lacal argues that a closer look reveals underlying weaknesses. Despite seemingly positive jobs reports, stagnant labor force participation and employment population ratios raise concerns. Government job additions coupled with tepid wage growth suggest a less robust job market than headline figures imply. Yeah. Government jobs really don't add to the economy. I mean, yeah, they keep people off the streets and from starving, but they cost people like you and me money out of our pockets so that they have a job. And yeah, that does get recirculated, but it gets wasted, you know. And of course, the government keeps their cut. I mean, they don't do nothing for free. So, all right. Lacal contends that the economy's apparent strength masks underlying vulnerabilities, such as a significant debt accumulation driving GDP growth. He warns that the Fed's fixation on headline figures overlooks these nuances, potentially leading to misguided policy decisions. Well, it was misguided to increase the money supply by 40%. I mean, that's what's created all the problems we're dealing with right now. Against the backdrop of rising yields and regional bank challenges, Lacal cautions that the market's bullish sentiment, dependent upon anticipated rate cuts, may face harsh realities. Delayed rate cuts could exacerbate economic challenges, particularly for small businesses and families already grappling with inflation and rate hikes. In navigating this dilemma, Lacal suggests the Fed faces a delicate balancing act, placating market expectations while avoiding exacerbating inflation or economic deterioration. However, regardless of the Fed's decision, Lacal warns that small businesses and families are likely to bear the brunt of any adverse outcomes, highlighting the complexities and risks inherent in the current monetary policy considerations. Yeah, and of course, the yahoos in government are trying to push through a border bill, which I think only 20 trillion goes for border spending, and then like another 75 trillion goes to Ukraine and Israel, which I could care less about those two countries. They get obliterated off the map. I'll sleep fine tonight, so it doesn't matter to me at all. And as far as the border stuff, all it does is allow for like 7,000 or 8,000 wetbacks to come across the border before any action takes place. So, me personally, I'd round up all the wetbacks and shoot them out of a cannon across the border. But, that's, probably a little too draconian for most people, but it's just how I am. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.